Well, good morning, everyone, and welcome to today's webinar brought to you by Spheria. I'm Matt Dell from Pinnacle Investment Management, Spheria's equity and distribution partner. The IPO for Spheria Emerging Companies Limited is going to be open for subscription this Wednesday, the 25th of October. So joining us this morning are both the founders and lead portfolio managers of Spheria, Marcus Burns and Matthew Booker. Since establishing Spheria in 2016, the Spheria Australian Small Companies Fund has delivered a 12% per annum total return and 7% outperformance versus the ASX Small Ords Accumulation Index as at 30 September 2017, whilst the Spheria Microcap Fund has achieved a 21% per annum total return and over 13% outperformance in a very tough market for microcap investing. Spheria's funds have been recognised by research houses and recently nominated as finalist for the 2017 Emerging Fund Manager of the Year at the Lonsec Awards. Additionally, Spheria Emerging Companies Limited is highly recommended by Lonsec. Now, please note that you can ask questions as we go along via the chat box at the bottom of your screen, and I'll now hand you over to Spheria's portfolio managers, Marcus Burns and Matthew Booker, for today's presentation.
Thank you, Matt. You've got Marcus and Matthew here, Matthew talking. Just in terms of Spheria, you're probably very familiar with us now. We have been together for nearly 5 years. That has spanned Schroders and Spheria, the majority of that time being at Schroders, where we've had strong performance across the funds. As Matt has said, that has continued across to Spheria. We now have over 400 mil in funds under management, and our microcap fund is just over 200 mil. We've been on the record that we will hard close the microcap fund at $250 million. So we're not far off that now. One of the issues we're facing at the market is the market has been strong and there's been some lofty valuations ascribed to some of the more speculative companies, and that does make it more difficult for us. However, we think our focus on cash flow businesses that are positioned well in their industry positions us well across the portfolio to perform consistently over time. We'll move forward to the next slide, which is slide 3. And Marcus will just talk about how our product fits into clients' portfolios.
Yeah, so one of the questions we get is, why would you consider small caps and how do they complement investments in larger cap portfolios? I guess the point we highlight here is, you've got two charts on this slide here. The top one gives you a breakdown of the sectors, the top 100 index, and you can see, as you guys are very familiar with, there's a very large concentration around two sectors there. So financials comprise 40% of that index, and the materials sector comprises roughly 20%. So with those two sectors alone, you have almost 2/3 of the top 100 stocks. If you look down at the small ordinaries index, by contrast, you have a much more diverse exposure to various sectors of the economy. I'll just flag there that consumer discretionary, consumer staples, and information technology, for example, are much more meaningful slices of that pie. And therefore you're getting a much greater exposure to underlying different sectors of the economy, which we think makes it a more diverse way to give clients exposure to different themes. Small caps and microcaps are also where most of the M&A and IPO activity occurs. So there's been a number of takeover stocks in the space in the last couple of years, and we see that trend continuing for the next couple of years as well. Large companies and international businesses are looking to acquire cash generative, lowly valued businesses in Australia. And it's no surprise that many of those takeovers have actually benefited the portfolio of Spheria. We don't invest on that purpose, looking for a takeover, but the kind of traits we're looking for, good cash flow creation or generation of the business, low valuations and reasonably ungeared balance sheets are also the kind of traits that foreign companies and private equity firms are looking to acquire. And of course, we do also pick up some very good long-term growth stories in the small market space as well. So bottom left hand gives you some names there that we've actually, most of which we've owned previously in our funds. Things like Dulux, Domino's Pizza, Car Sales and TVG, to give you a couple of names that ultimately joined the top 100. So were incredible growth stories for a long period of time in the small cap space and gave us many years of good compounding returns. And Matt and I and the team are looking for ideas like that where the stocks fit our process on a fundamental basis. On the next slide now, to give you some flavour of the universe, you can see that large cap stocks are, by definition, large. The average market cap is $16 billion. I guess what we're trying to flag from this is that as you go down the spectrum, you get a much larger number of stocks to look at. The market cap shrinks dramatically, therefore the coverage by the sell side is reduced, and so fundamental research that our team brings becomes more valuable in a relative sense. And then finally, the dispersion of returns is much bigger. So as you go down the spectrum from large to small to micro, you can see that the possibility of outcomes dramatically expands from, in the large cap space, you can actually double your money if you happen to have bought Qantas shares in the last 12 months. But by and large, you don't get that kind of return in a large cap company because it's so large. As you go down to smalls, you see that the variation of outcomes is much bigger. And again, in micros, the outcomes, again, from losing everything to making 17 times your money in one single year, are the kind of dispersion of returns you can get. However, there is downside as well, and thus our focus on the basics, cash flow valuations, etc., should see our portfolios perform better than average through a cycle. And that's really how we think about investing and what we're trying to achieve.
Just moving on to slide 5. Now, everyone says they buy quality businesses. What is the definition of a quality business? And what we try and do is cut through all the noise and get to what a company is producing in terms of its cash flow. And when we talk about cash flow, we talk about free cash flow. So that's after all capital expenditures, all the nonsense that you see in the market, EBITDA and normalised earnings, all that sort of stuff. We're cutting through to the cash flow statement and working out what exactly this company is going to generate in terms of cash flow, because we believe companies are simply worth the present value of future free cash flows. And people do lose sight of that through the cycle. Obviously, you get upswings in the cycle and people get caught up with share price movements, and you get downswings where people become very bearish on certain companies. What we do is we dig beneath the surface of a company and we look at how sustainable that cash flow is. So we look at margins through the cycle. We look at sort of growth that the company can generate through the cycle. And what we're trying to come up with is a sustainable cash flow picture to value these companies at. We're very fundamental focused, and we do a lot of work on balance sheets just to work out the risk in them. And we just don't take the debt on the balance sheet at the period end. We look at the balance sheet over the period, and we also look at off-balance sheet debt. So that includes leases. Now, leases can be very damaging to a company when conditions turn down. Ultimately, what we're trying to get to is a low-risk company that's generating good free cash flow, and what we're trying to do is discount that cash flow to present. And ultimately, we're trying to buy these companies at a discount to valuation. So there's definitely a valuation overlay in what we do. We don't want to get just caught up with noise and momentum. What we always say is we want to keep an open mind. Facts do change in the industry. You get changes in businesses. You get changes in management teams. You get changes in boards. You get shifts in strategy. The other change that you sometimes get is an industry structure change. You get M&A and you get consolidation, and sometimes that can be positive. Other times it can be negative. So you need to be aware of those changes in the market and in the industry structure and that business and its direction. So we try and keep an open mind to companies. Just because a share price is down and out doesn't mean it's not an opportunity and there's not a quality business in there that we can buy. Markets are definitely inefficient in small and micro caps. We do a lot of groundwork. We get out there and see a lot of companies. We also do that hard work around numbers, and we look at the financial history. We automatically populate all our models, and we make sure that we're basing all of our assumptions, all our recommendations on rigor and numbers that validate what management teams are saying. So there's a lot of rigor into what we do, and we think that results in a positive outcome over time for the clients. If we move on to slide 6, this delves into our process. Now, I just discussed risk. Risk to us is the event that that something goes wrong with a company and we get stopped out. So we have to be very careful how indebted a company is, both operating leases and balance sheet debt. I spoke about that. Also, where the company is in its cycle. The last thing you want to do is buy a company at the top of its cycle. And if you look at Monadelphous, and we talked about Monadelphous in an ensuing slide, that was a company a few years ago that was at the top of the cycle. It was a good company, but it wasn't the time to buy it. So you have to be very careful about when you buy a company. The other thing we look at is operating leverage. Operating leverage is when there's a lot of fixed cost in a business and you get a slight change in revenue and it impacts your profitability dramatically. And that can also mean that you get stopped out in that investment. So we're very cautious on operating leverage in businesses. It can work for you, but it can also work against you. What we also do in terms of our valuation scorecard is we work through the Porter 5 forces, and many of you who've studied economics will understand that framework and how we establish the competitive dynamics of that business in the industry. We find this is a very important tool to create debate amongst the team and also to create differentiation in valuations. So what we do is if we find a company that scores well on that Porter's basis, we actually put a higher multiple on that cash flow stream such that we get differentiation through the cash flow and also through the multiple we're applying. So we find it an important basis for making our recommendations. As I discussed before, the investment team also does a lot of meetings. It's not just with the companies. We get out there and see competitors. We go out there and see customers and suppliers. We try and get a look from every angle on a company rather than just take what management is saying as gospel, because that can be dangerous in itself. Many of the management teams can obviously lead you down a path which they ultimately try to drive the share price higher.
Yeah. So just contextualising that now with a real life example. I mean that slide Matt just showed you on the investment process is not one I think we shared before, so it just gives you some background. And those all those colour charts and colour codes are actually present in our valuation spreadsheet basically, so they give you some flavour as to how deep we go on some of these numbers. But taking that framework and applying to a company called Vita Group, which I'm sure many of you are aware. Vita Group is the Telstra, runs the T-Life stores for Telstra and on the East Coast. They run 100 of the 300 stores in Australia for them, so they're very important. First of all, if you look at the cash flow conversion chart, which is the top left-hand chart there, by the way, this is a chart we automatically generate for all the stocks we're looking at. It gets populated automatically, so we can see a long history of a company's cash flow conversion, which, as you know, is integral to how we operate and invest. And on the face of it, that's an incredibly good free cash flow conversion history of Vita Group. However, if you look at the margin chart, which is the next one down, and the bottom left of that chart, you can see that basically it's gone through various cycles. So when the company IPO'd in 2006, the margins were incredibly high. They got squeezed back due to the competitive pressure from Telstra, and then Vita Group managed to put in some good operating efficiencies, lift the sales per employee, and get great returns. This is also a good example because it's a share that we've held historically. So in our previous shop, we bought these shares very cheaply, around the 20 to 30 cent range, and the stock performed exceptionally well as those margins expanded. You can see that from the low in 2012-13, the margins went as high as almost 11%. Now at that level, we thought the stock was capitalising in a lot of the future margins and probably a margin level that was unsustainable. On the previous chart, when Matt's talking about the Porter 5 forces, we flagged that Telstra, which is a monopoly supplier to Vita Group, obviously has a lot of bargaining power vis-a-vis Vita Group, and therefore when you get very high margin expansion in a company like this, we become cautious around the outlook. So we sold those shares previously. Fast forward a year or two, and there's rumours in the marketplace around Telstra looking to renegotiate the contract and take some margin back off Vita Group. The shares fell fairly precipitously from roughly $5 to a low of 80 cents. We thought that using an average margin over the cycle of around about 4% was probably good investment sense, and we got a valuation well above the 80-cent share price at the bottom there. So we started buying that around $1 and continued to buy as the stock fell because we thought the balance sheet was very good, net cash, operating cash flow conversion was extremely good, and we also thought, flipping it around, that whilst Telstra had a monopoly position against Vita Group were also very important for Telstra in a long-run sense as well. So we figured there'd be some long-term common sense that came through. And just having forward to the next slide here on page 8, you can see this is the history of the share price. We haven't gone back to 2006, but you can see that obviously there was that great recovery, hit a peak of over $5, and then it fell, retraced several times, and you can see where Spheria bought. Obviously, we as a team discuss all the pros and the cons of this. We discuss the strengths of the business, and we formulated a view that actually was massively over-discounting what the business should likely earn into mid-cycle. And then just to flag now, even though the share price has recovered quite meaningfully, it's bounced from 80 cents to roughly $1.50 today. The cash flow generation of the company means that it's trading at around about 5 times cash flow today. So that means within 5 years, assuming steady state, you can effectively earn enough cash to completely pay back the share price. So we think it's still a reasonably attractive investment, and it's in our portfolios. We've made good money in our small cap portfolio, and it currently sits in the portfolios at a reasonably big weight.
Just taking a step back, we say Telstra's an infrastructure player. They're not good at selling products and services, and I think that anyone who's dealt with them as a consumer would vouch for that. So what they need Vita Group just as much as Vita Group needs them. So, Vita Group is very good at selling phones, very good at selling broadband packages. They control a third of the network, as Mark has said. And I think that that symbiotic relationship is underestimated. And therefore, going forward, just from a common sense perspective, we think Vita Group has seen the worst, and that 5 times cash flow, as Mark has said, it's compelling value. Just moving forward to Certex versus Mesoblast, and this is where we really contrast two companies that are valued basically equivalently in the market, but it just really contrasts the difference in cash flow dynamics for the businesses. If you look to the right there, you see Mesoblast, and Mesoblast is doing some research into stem cell regeneration, and it might be really successful. We don't know at this point. I don't think the market knows. But the market is factoring some degree of success at this point. It has burnt over $100 million of cash flow in the past 4 years per annum. So you can see that in the red bars. It's burning a lot of money to get where it needs to go. It's having to rely on the market to raise money to survive. So it's coming to the market pretty much every 6 months. So it's running out of cash. Now, if we go to the left and look at Certex, Certex is much further down the path of commercialisation in that biotech space. It has a product that has efficacy in the liver cancer salvage treatment market. Now, the penetration rates for Certex products are around 8% of the market. Now, their product, it's gone through a lot of trials. It's got the same efficacy as the chemo agents, but the quality of life on the Certex product is much, much better. So we see over time that penetration rate improving as they take share from the chemo agents. And we think it's very much at an early stage in terms of that penetration. So that 8% can go a lot higher. Now, if we step back, the companies are valued equivalently, but Certex prospects, we believe, are very strong and very predictable from this base. Now, it's generating 40 to 50 mil of cash flow at the moment. That revenue will grow as penetration increases. The trials are over now, so a lot of that cost that they've had to capitalise in the last 16 years effectively, particularly in the last couple of years, is now over, so that cost drops out. So you're going to see significant cash flow generation from this company. Now, there will be challenges for Certex. There's a few roadblocks along the way, but we think over time, just having the best product in the market, we'll see it outstrip its competitors.
I'll just give you an example of a growth stock that we own the portfolios and have had for some time, is Class Super. Now, this is the leading SMSF platform for self-managed super funds. I guess the reason we flag this stock is it's one that went from being pre-cash flow generation to generating cash flows. We bought the stock in the IPO about 2 years ago, at around about $1 a share. And again, that on the left-hand side there, you can see their cash flow conversion chart, which shows very good history of this company since it for the last couple of years. The cash flow generation has been strong, balance sheet net cash. And whilst the PE ratio is fairly high, it's our view that because the business has generated its growth all organically, it hasn't acquired to get this kind of growth, it's just taken share from competitors, it's worth a higher multiple than perhaps the market would necessarily ascribe to. So Matt and I have discussed this one. We think it's competitively very strong. We think that over mid-cycle, this business can actually get to something like 45 to 50% market share of the SMSF market, and that ignores the fact that it's actually moving into adjacent markets like the family trust market and the class portfolios product, which we think is another further growth leg this company has to its bow. And so, this is a stock that's been in a portfolio for a period of time. It's tripled since we've owned it, generated great returns for our investors, and we still believe there's a really good long-term history of this company. I guess we just flag this because we do look at turnarounds and management changes, but we also are prepared to pay up for companies where we see demonstrable quality growth, and this business ticks all those boxes from our point of view, and is a really core investment for our funds, and we own it, and we still own the business in our funds, and we think it should be a good return in medium term. And just lastly, this is where our funds are currently positioned. So top 5 holdings are on the left-hand side there. We've spoken through a few of those positions. And on the right, you can see that we have exposure to pretty much all sectors in the small cap space. We don't get asked the question a few times, do we eschew mining or mining service companies? Are we only industrials? The answer is no. We look at all sectors and from as Matt said, from a very bottom-up point of view. And if they meet our criteria, we'll happily invest in those things. So we do have some resource stocks in the portfolio. We have done pretty much through the cycle. And we feel that periodically you're going to find very good opportunities to buy all stocks in all sectors, as long as they meet the basic criteria of having good free cash flow conversion, evaluation is supportive of the case and balance sheets aren't overgeared, we'll consider that a place to invest money. We are overweight consumer discretionary and information technology. That's a bottom-up decision, not top-down. But we do have exposure to other sectors, and periodically those sector weights move around based on where we see the best opportunity for our investments.
Just moving on to slide 12. So what we're trying to do is just keep it simple. As discussed before, we're trying to buy companies where we can predict future free cash flow and find the NPV of that and buy it at a discount. Obviously, we'd like to avoid gearing when we can. That's not always the case, though. When we do buy companies that are geared, we try and manage that size in the portfolio. But what we're trying to buy there is companies that have good cash flow to back up that debt or that gearing level. Our strategies are capacity constrained, and you've seen that with the microcap fund. It is soft closed at the moment, and it will be hard closed at $250 million. The small cap fund has around $200 million under management now. Clearly, after the LIC, that will be a lot higher, and we will hard close that product when it reaches $700 million in FUM. So, we do not want to take on too much money. At the end of the day, that will compromise performance, and we're going to stick to our capacity limits, which we've discussed before. Look, this part of the market isn't well covered. We think we've got technology and experience to really cut through and find those companies that offer good value in the market. And we think that's an important attribute that the team brings to the small cap market. Now, the actual LIC is, we think, quite innovative in that, we'll be paying back the listing costs, which means that the book value at listing will be the same as the IPO price. So we think that'll be good for investors. In terms of recommendations, we're very happy that Lonsec has backed us with a highly recommended on this strategy. They have supported us on the other products as well with the same recommendation, and they see a consistent delivery in the past and a consistent process that's been proven for some time now, and a team that has a good track record. So we're very happy with that rating.
Okay, thanks guys. Now, just a reminder that all attendees can ask questions via the chat box just at the bottom of your screen. And before we turn to questions, I'd just like to take all the listeners through just a few of the key dates for the IPO, which you can see on your screen there now. So the IPO for Spheria Emerging Companies Limited will open Wednesday this week, the 25th of October. Broker firm closure is the 17th of November. And general offer closes on the 24th of November with ASX listing on the 5th of December. Just on some key offer statistics, we are seeking to raise up to $250 million from the IPO, but please note that the capacity constraints for this investment strategy means that we won't be taking any oversubscriptions, and stock will be allocated on a first-come, first-served basis. So if you are seeking an allocation, I'd urge you to get your subscriptions in early, as we have experienced a fairly high level of pre-IPO demand. Matt's also mentioned to you that Spheria is going to bear all the costs of the IPO, hence there won't be any options. And that means that the shares will list at their $2 subscription price, and as Matt said, that's a good outcome for investors. We'll also be paying a fee of 1.5% to advisors, inclusive of GST, for those advisors who allocate through the IPO. Okay, so we've got some questions here. So firstly here, to both of you, because of the cash flow focus, do many of your investments get taken over?
We have found in the past that the investments we invest in get taken over. Some of that has to do with where they're strategically positioned as well. So what we're doing is we're trying to buy companies that have a competitive advantage. And often the case is that these companies have either decent market share or some barrier to entry with their business. And that's why the cash flow manifests. It's a byproduct of actually the competitive position of that company. So yes, we've had a few takeovers in the recent past. I think we had Fantastic Furniture, Royal Wolf Holdings, what was else? McMahon was bid for.
SMS Consulting.
And SMS Consulting, all companies which had some sort of competitive advantage that underpin that cash flow. So yes, that does happen.
Another question here. Can you access companies in pre-IPO?
Yes, we can, and both the SEC and the Small Companies Fund can buy pre-IPO as long as there's a reasonable likelihood the company will IPO within 12 months. It's something we've done very selectively in the past, only a couple of times in the last 4 or 5 years, and on a selective basis we may do it again in the future, but it's going to be based on high quality businesses where we see good opportunity and also, as I said, a very likely listing within 12 months. The maximum of the fund is 10% that can be allocated to pre-IPO.
Just got a question here on Vita Group. Is it a concern that they're diversifying into other industries?
Look, Vita has a very strong core business, but they are reliant on Telstra, their supplier, as we discussed before. So we think diversification is good. They're not betting the house on it. They're only investing $10 million in this investment. It is in the cosmetic aesthetics market, so a lot of it's to do with collagen injections, etc. But the business they're buying is very small, and it's a big market that is growing fast. So it has all the hallmarks of where Vita Group's been successful in the past. It also uses consultants. The Vita Group business is very consultant-driven, and the business they've moved into is very consultant-driven. So there are some synergies between the businesses, and it is a big market. So if they get it right, great. If they don't get it right, it's not a big investment.
Yeah, they haven't bet the firm. Like they haven't spent half market cap of the business trying to acquire a new sector, which I think is important. So if it doesn't work, $10 million investment and some time in management team, it's obviously not great, but it would cost a few % of the share price rather than what typically happens when a company seeks to diversify, is it buys a massive acquisition, gears up the balance sheet and takes on a huge amount of risk. And we don't see this as a massively risky way to try and create value in the future.
But a good question. Thanks.
Yeah, great question.
Another one here, wondering, with more new micro and small cap managers in the market, is it harder to find shares to fit into your portfolios?
Look, at the moment, like I said, the market is very speculative and it's very hot, which means that you've seen, some significant valuation re-rates out there, which does make it harder. Now, we are finding some value outside of that. It is selective. But definitely, there is definitely strong demand out there from some of the other managers, which is pushing share prices to levels which we think aren't sustainable. But, we're probably avoiding those kind of companies at the moment and focusing elsewhere. So there is definitely selective opportunity available.
Also, it does change as well. I mean, if you go back a few months, we had one of our peers shut down a business, shut down a fund, or actually have a lot of redemptions, and that created opportunity for us to invest. So, more people picking over space is not as good, but on the flip side, there are still opportunities we're finding, I guess, on a bottom-up basis.
Okay, so how many companies do you have on your watch list that aren't in your current portfolio?
Oh, look, there's plenty on our watch list. I mean, Marcus and I are discussing a lot of the companies. We've modelled up a lot of the companies, and we're just waiting for the right entry point at the end of the day. And the market is quite volatile. If you're a have, your share price is going up. If you're a have-not, it's going down fairly precipitously. And the have-nots can become the haves. So we've just got to keep an open mind to investment and just focus on, what is sustainable cash flow for these businesses, and then have a valuation. And when it becomes very disconnected, that gives us a margin of safety to buy those companies.
Yeah, in the small cap space at least, we try to have a view on, or at least have almost all the companies modelled up or on our watch list. As you go down the cap spectrum to micro caps, it becomes a bit more selective, doesn't it, because there's so many stocks down there. There's over 1,355 on that chart I showed before, above 10 million in market cap, and we're more selective there because only roughly a third of that universe actually make cash flow and earnings, so we typically screen down to that level. But there's many on our watch list, and as Matt said before, we try and keep an open mind, so things change. We need to have a view on stocks changing and management teams changing. So even if stocks don't fit our criteria now for whatever reason, if there is a switch over of strategy, we need to be aware of that and take advantage of that.
Here's a leading question here. Small and micro cap stocks have underperformed the broader ASX 200 for a number of years. Do you think now is the time for them to catch up, considering they have great growth prospects and then the larger parts of the market often?
Look, we hope so, and we think that concentration in the large cap end of the market is risky, and that you can get great diversity down into small and micro caps. You can find the next growth companies, or you can find companies that are simply undervalued that where the discount will unwind. So we always think there's opportunity, whether it's a bull or a bear market. We'll navigate through that and find those opportunities which we think will add value to the portfolio.
And just one final question here, and it's probably one for the board, but question about dividends, and do you think you might have paid your first dividend by this time next year from the company, from Spheria Emerging Companies Limited?
The prospectus of the SEC says that dividends will be paid at least annually, and so I would imagine within the first 12 months, although it's not hard in stone, it'll pay dividend within 12 months. It's really subject to the availability of earnings and franking credits, because the aim is to have a dividend yield paid which is fully franked. But our underlying stocks pay us dividends and pay the SEC dividends, so we expect there to be a dividend. And just by way of some example, the underlying yield on the fund on a trailing basis is about 3.5%, fully franked. That's on a trailing basis. It's actually higher if you don't normalise it, because we got some special dividends in the last 12 months. And on a prospective basis, the underlying yield is around about 4% on the current holdings in the portfolio. So it does yield pretty well, but obviously it's probably predominantly a growth vehicle.
Okay, thanks, guys. So just to wrap up here, we're going to make this webinar available on spheria.com.au later today. If you have any further queries, please refer to the Spheria website or contact a member of the Pinnacle distribution team, which you can see on your screen there now. I do need to just quickly show you the disclaimers, so that in case my compliance people are listening here. But thank you for your time today. We look forward to speaking to you either in person or at your office or at our next webinar. Once again, thank you and have a good day.
Thank you.
Thanks again.